Hi, welcome to today's video and thanks for joining me. Today I'm going to be answering this subscriber question. David, how do you use life insurance to generate that tax-free income you've been talking about in other videos? Now, you didn't want me to show an hour-long video about the full strategy. You just wanted me to show you sort of the high level, what's the outcome and how does this work and would it apply to me? So that's what I'm going to do. I'm going to try to do this in a very short video. Life insurance is one of the easiest things you can do that produces the biggest result without breaking a sweat, okay? So let's pay attention. Let's set this up for you. This couple was 58 years of age. They're now retired. Their home is paid off. It's worth, let's say, $2 million. They've got a cottage, or maybe it's a condo in Florida. Does that look like your situation? They've got RSPs, TFSAs. They're going to get CPP and old age security. That's their assets. Pretty simple. No pension. Just Government of Canada, CPP and old age security. And they're like, okay, how do we use this money? And they say, oh, by the way, David, we're going to downsize our house because the kids are gone. We don't need this big house anymore. So you sell the house. And let's say you buy a condo, $1 million. And now you've got $1,900,000, maybe $800,000. It's sitting in a non-registered account. And when you get your financial plan done and you look at that, it doesn't say you really need that money at all. In fact, because you've got the RSPs and the TFSAs and the CPP and old age security, you don't really need that non-registered amount. So that means you're going to pay tax on an asset that you're not going to actually use. That's frustrating. It's a good problem to have, but it's frustrating. So you go, okay, well, what else could I do with this non-registered account? Well, watch this. This is going to blow your mind. Did you know that when you deposit money to whole life insurance, the cash value grows and you don't pay any income tax on that? Pretty remarkable thing. So it starts making you think, wait a minute, that's better than a TFSA because you can only put in a maximum each year. I can put more in a life insurance policy. How much more? Well, it depends on your budget. So in this case, it's $100,000 a year I'm going to show you. And you're like, what are you talking about, $100,000? Well, think about it. If you had $1 million in a non-registered account, you would easily be making $50,000 a year in growth in that policy, in that non-registered account. So if you're only doing 50 into life insurance, you're really not digging into your own capital. So that's why I'm showing you 100, because you're really trying to shelter some of that non-registered money into life insurance so that you don't pay any income tax, right? Okay, so now that you see that reason, now you say, okay, that makes sense. So $100,000 a year for 6 years, they put $600,000 in. And you can see the cash value grows, the death benefit goes up each year. That's what's unique about whole life. Your cash value goes up every single year. Your death benefit goes up. Universal life, you can't say the same thing of that. It fluctuates all the time. Now you flash forward to age 71. Now I'm just saying 71 because I'm just showing you how, like a timeline of how you might use this. And you go, you know what? I think I'd like to use some of that cash value. So look at this, line number 13. You're now 71 and you got $828,000. Now you could have taken 90% of that money anytime you want. There's no restriction here. They just allow you to take 90% of your money at any point through the timeline. But you waited till age 71. And you said, you know what? I don't want that full 90% right now. I would like to just receive it like an annuity. Could you just give me like a cash flow each year to supplement your lifestyle? Say, no problem. How much would that be if I was to receive 71 at age 71 to, let's say, age 85, 86, the year when most people in Canada, the average death rate in Canada, that would be a good supplement. So that works out to $56,000. So you see that loan amount. What you're doing here is you're going to a financial institution. They're giving you a line of credit against your cash value. That's simple. Be no different than if you had a rental, let's say a rental unit, and you were collateralizing the capital, the equity in that rental unit, taking that money and using it to spend on lifestyle. No different. Think of this as an alternative investment. And so you've got this cash value. Now you've got $56,000 a year coming in, and it's non-taxable. It's a loan coming into your hands, so it's not going to claw back your old age security. You're not going to increase your tax rate. The only thing you're developing here is a loan against your cash value, and, well, your estate value is going up. That's another good thing. So if we flash forward now all the way to age 85, which is now line 28, you can see that they have taken $56,832 per per year for the last 15 years, and they pass away. Okay, now what happens? Well, you've got this loan now of $1.3 million. You never made any payments towards this loan. The interest just capitalized on itself. But the death benefit of the policy is $1.9 million. So the life insurance pays off the loan, and there's actually $574,000 left over. Man, that just doesn't work in a non-registered account like that. When you start drawing down on that, and because the tax grind is costing you more money to use that money, you're actually going to deplete your non-registered asset. But in a whole life insurance example, you're actually going to have use of that cash value much longer than you would have a non-registered account, and you're going to have money left over. It's the most remarkable strategy if you're able to do this, because you got to be healthy and you got to have the capital. But if you can, man, you're using your money in such a more tax efficient way, much more so than just leaving it in a non-registered account. Well, I hope you enjoyed today's video. Remember, put your comments below. I want to hear what you have to say about this strategy. I look forward to seeing you in the next video. Take care.